So the client is now thinking, like, I have 24 hours to basically produce this deposit. The money's in my FHSA. I can't get it out. What the heck am I going to do?
You're listening to the Ottawa Real Estate Podcast, your go-to source for all things Canadian real estate. And now, here are your hosts, Paul Stevenson and David Warren.
Hello and welcome back to the Ottawa Real Estate Podcast, your go-to source for all things Canadian real estate. My name is Paul Stevenson. I'm joined, as always, by David Warren. We're both level 2 mortgage agents, and David is the owner at Referral Mortgages. And we're back. We want to say quick thank you to our amazing sponsors, Guertin, Poirier, Avocates lawyers, Big Insurance in Westboro, Centum, and Easy Neon Signs. EasyNeonSigns.ca. Use the promo code TOREP and get 20% off each and every order. Also, David, before we get into it, I just want to take a quick minute, being that it is Remembrance Day today. I know this comes out tomorrow, but I just wanted to take a second to thank all of our servicemen and women for your service, your sacrifice. We're very grateful for what you've done for our country, and we remember. As Canadians, we should remember. Get your poppy if you don't have one already, and thank you. David, how you doing? How's the week?
Week was good. I was away at another conference, the Centum Network Conference I mentioned last week. I was heading away on it, so I was there the past 6 days, coming back to obviously Armageddon of snow and ice here back in the Great White North. But overall was a great week connecting with other brokers and owners and lenders across the country. So it was very informative. Some great conversations about, what some of the different lenders are doing, what they're coming out with, what kind of things they're seeing. So overall was, I always take some good tidbits away from those.
Yeah, what sort of any key takeaways? Any engaging conversations that you thought, you know what, I need to implement that, or here's something that's changing that I need to prepare for?
Really, kind of a lot of the topics of conversation and any sort of the economic updates and things like that were really focused and centered around the number of, obviously, we've talked about it ad nauseum, upcoming number of renewals and kind of that, what lenders are doing to prepare themselves there. And no surprise. And like we talked about, that lenders on renewals are looking to be, pretty aggressive to retain those clients. But at the same time, they're also looking at being aggressive to acquire new origination or new business. That was kind of a, some of the talk around just kind of around that. And another major lender, Home Trust, as we were there, just got back into the A space. They left for a while due to their owner also owning a large percentage in First National, but recently sold it. So he had to pull out of the A space for a while. So they launched back into the prime or A space while we were there. So that was obviously, it's not really that interesting to listeners, but it gives another lender in our tool belt that's always been, they were for decades in the prime space. So that's always, a good thing.
Yeah, that's a good points. Great points. I do want to touch on renewals because that is something that we're seeing. Well, we're obviously seeing a lot of it just because of the sheer number of renewals that are happening in the next 18 months is large. Large is an understatement. But the state of the market right now, like I've found, at least in the last 2 weeks, usually the snow deters people from getting out, but I think it's actually prompted people to be a little more urgent because everyone knows typically the busiest market time, I guess, of the year cyclically are spring and fall. That's like, just historically, that's when most of the transactions are happening. So fall markets typically kind of that, September to mid-November is kind of when like a lot of people are transacting before they hibernate essentially for the winter, right? Now, we've always talked about there being incredible deals in January. I think 2 of my last 3 homes I bought in January or in December, kind of closing in January, February, just because sellers are a little more willing to negotiate. You get, as a buyer, you have a little more wiggle room. A lot of people pull their listings off of the market as well in November, December, and kind of wait till that spring market hits again, knowing that that's kind of the peak when they're going to get a lot of eyes on it. But this last week and a half, I would say, it seems that a lot of people that were shopping are now buyers. Like they're getting a bit more aggressive. I've seen a lot of APSs come in the last basically 10 days just because people now that have been shopping for 4 to 5 months have finally found something and they're seeing that. So state of the market just in general, like what are you seeing on your side, Dave? And, what are some of the things that maybe some of the challenges that you're encountering in dealing with that kind of state of the market?
Yeah, I mean, still seeing a number of purchases. For myself, kind of making up that 1.2 million Canadians or more, 1.2 million mortgages coming up for renewal. Looking back 5 years ago was the start of COVID and a flurry of the market. So a lot of my conversations on a daily basis are renewals, and a lot of my clients up for renewal, looking at that renewal strategy, fitting within their budget. Again, we've talked about it quite a bit, but purchases as well, and purchases where they needed to sell their home, not able to. And so, we're kind of making that decision of let's take it off the market, keep it as a rental, pull that equity out, use that for the purchase of the new home, and kind of those last minute pivots, if you will. And so that's seemingly kind of a prototypical thing right now as well. Just again, things moving a little bit slower, picking up in some areas and in some markets. But yeah, those have been a lot of mine. I know in your case, I believe you were telling me in your market, you're seeing a lot more purchase agreements as of
Yeah,
late.
still a lot of renewal conversations just because, again, just as I mentioned, just the sheer number of renewals that are up. Like people are just existing clients over the years are kind of reaching out. What are options now? I will say probably half of the conversations I'm having about renewals are simply that. They're conversations. They're not actually leading to transactions or like transferring from one lender to another. A lot of the times the conversation is, what's your current lender offering you? It's more of just like an advice based catch up. Like, okay, what's your lender offering you? What's your goal with this renewal? Are you looking to pay off any debts? Is this just like a straight dollar for dollar renewal and so on? And it's really a matter of understanding, again, like what is your goal of the next 5 years or 3 years? Like what changes do you see happening? And just kind of bringing everything back up to speed for that renewal conversation. But a lot of the time, I'd say, like I said, half of the time, I'm advising them to renew directly with their existing lender. And is that good or bad? I think it's good just because I really do want to try to give like the most neutral position possible, and I always try to put myself in that client's shoes. Okay, you have whatever 400,000 owing on your mortgage. You're being offered 384 from your existing lender, and all you have to do is literally click a button or initial a piece of paper. Like, I'm not going to make you go through a whole application, whole pre-approval process, like basically, potentially an appraisal, et cetera, to get the exact same rate, or maybe, zero point 0.02 lower or whatever. So I kind of use that as an opportunity to further strengthen that relationship with the client and have that conversation. But I would say at least half the time, those renewal conversations, it's literally tell me everything that you're offering. And the lenders I find are being a lot more aggressive on their
Okay.
renewal rate options for their existing clients, which, I would say a year or two ago, they weren't doing that. It was kind of like, well, this is what we're offering you, take it or leave it. And most people weren't looking. I think people are more attuned now. People are looking for ways that they can save. And I think we've been beating the drum for a while now that you're going to have some payment shock on your renewal. So I think people are doing their due diligence, they're doing their research, they're actually looking at what options are available to them for the renewal. And that's where we come in as advisors to say, listen, like you have the best option in front of you, take it, and I will be the first to tell them that. Something I have heard though, and I haven't seen it personally, but I have heard this from some of the kind of leaders that I follow online, is that the alternative lenders, so not kind of your Schedule A banks or monoline banks, but the alternative or B space, B lenders, a lot of them are not renewing clients that are up for renewal. So typically those are shorter terms, 1, 2, maybe 3-year terms. And from what I understand, on the 1 and 2-year terms, the lenders are in some cases not renewing those options. Now, there's a number of reasons they could do this. It could be maybe they missed a payment. Maybe, there might be delinquencies in there that make them not like just kind of a standard, we're not going to renew this because of. But it seems like more of it is kind of that retaining of capital and not wanting to keep that money out. Are you seeing that, or what are you hearing in that regard when it comes to renewals in that alt space?
A lot of it's risk analysis and them looking at markets like Toronto where values have come down so drastically. A lot of them do, the lenders in all spaces, but especially the alt space, is they do a blanket appraisal on all of their book, and they look at an automated value of those properties. And it ends up being, especially in markets like Toronto, condo market, high rise, things like that are more susceptible to default, that loan to value has shrunk, and it's in a range in which they're not comfortable, where if there is a default on that mortgage that they then have to take it over, there's not really any margin there, or the loan's underwater on it. And so they're looking to, again, hold that capital. A lot of them are also having to allocate higher amounts of capital for projected losses. So loan loss provisions. So we've been seeing that over the past number of quarters. If you're looking at any of the major banks' financial statements, but as well the alt space, their loan loss provisions are having to ramp up in that expectation.
Mhm.
And the same we talked about last week, I think it was, with the lender, like Equitable Bank laying off 8% of their workforce. That's them projecting and having to, save that capital in one fashion or another to allocate to that loan loss provision of their expectation, where the market's heading, and, needing to allocate it accordingly. So I think for some of those, it has a lot to do with that and those blanket appraisals.
Yeah, and appraisals is something else that I wanted to touch on because we both had instances this week where appraisals came in different than what we were expecting, and I'll let you kind of lead off because I know you just had this ran into this yesterday. Mine was last week, but inspections and appraisals, that's something that, we don't talk about that often on the show. We have talked about appraisals in the past, but I've seen more clients and lenders actually recently walk away from a property or walk away from a file due to the review of the inspection or of the appraisal. So I can touch on that, but tell me like, I just want you to reiterate that story that you told me about the appraisal, because this is something that people don't think about. They buy a home, they get their mortgage financing, but hey, we also might need an appraisal, especially on refinances, right? Where prices right now are kind of fluctuating. People aren't really sure what their value is. And on our end, when we're doing a refinance, for example, where someone wants to pull equity out of their property, you obviously know this, Dave, but for our listeners, we have to, or the clients have to essentially estimate what they think their property is worth. So, if they're looking to do a refinance of their property and say, oh, I think it's worth around 800, that's kind of the number that we do kind of a general assessment based on our knowledge of that area and so on as well. And say, okay, yeah, 800 seems reasonable. We submit it to the lender at 800, and then 99.9% of the time the lender wants to do a full appraisal to make sure that we have that value of 800. Now sometimes it comes in higher, sometimes it comes in lower, but on purchases it has a bit more of an impact, right?
Hmm. Yeah, I mean the one this week was kind of comical in the sense that it was a new construction with upgrades, 631 being the purchase price. Appraisal came in at 627, which I was 4 grand light, which really isn't like a big amount, but was just comical in that. Really in that, for those that are clients and or a mortgage broker, like you can appeal a value. And so that's exactly what I did. I went back and said, "Hey, did you not read through the upgrades? Did you not do this, do that?" And they updated the appraisal accordingly, matching that. But I have had it where in a lot of the major banks, you have to order an appraisal through a third party appraisal system, so a blind order, where a lot of times they're assigning just junior appraisers. And I've had it where it's an appraiser that isn't from a specific area or market come into town doing that appraisal, and the appraisal being substantially light for what it is or done
Mhm.
incorrectly. Again, those are cases where you need to be reading that report and go through it, and that's something that we as a broker can request a copy of that report to go through when there's a discrepancy, and we're not able to share it with the client, because it is actually owned by the financial institution, but we can look at certain aspects of it to appeal through that system. And that's what I did on this and on other cases. But one thing, and that came up in conversation this past week at the Centum conference that I was at, was with a couple of the major banks, like Scotia and BMO, that I was speaking with in the past. New construction, new builds. A lot of the banks would have blanket appraisals based on the sale prices that the builders went in at or what they're listing it at, saying, okay, we're good with this. They've told me they've all gone away from that. They don't have those they're not relying on those appraisals from when a builder provided their list price of what they're listing it at. They're not going by those anymore, and they are looking for those full appraisals, and not kind of using that other, like, okay, builder XYZ listing at this, like we'll go, yes, we'll go on that from 2 years ago of an appraisal based on that list price, and we'll hold that as a blanket for, on an ongoing basis. They've wiped that away, and not relying on those. So they are looking for those full appraisals, up front now, or as you're approaching closing.
Yeah, and I found, like you said, way more in the last probably year than before. And it's kind of ironic because you would think with all of the, like we are talking about, like all the AI tech and the tools and stuff they have to have those valuations, they're actually relying more on the human being going out, assessing it, using their experience to kind of evaluate what the actual value of that property is. I had a situation where client bought a property. It was going to be a rental property that they're buying, 20% down. Value, it was a lower price point, 280. It was basically that there was two appraisals, one for the actual value. The second was for a market rent appraisal. They're using it as a rental. We needed to value. We were talking about this a couple weeks ago, like how lenders factor in the rental income on properties and so on. So because there was no tenant in this property right now, it was currently owner occupied, was going to be a rental. The client had to get what's called a market rent appraisal. So it basically, the appraiser, while they're assessing the value of the property, will also tell us what the assumed rent is going to be for the neighborhood, for the building, etc. So we needed 2,000, and the lender, who was a bank, specifically said they're making an exception on the total debt servicing. So the total amount of their annual income that's going to, their mortgage payments, all of their other debts, et cetera, et cetera. So overall total debt. They said they were making an exception. It was at 50.01 or something. And they basically said, like, we cannot have this TDS go a penny higher, can't be a single dollar over, et cetera. Goes out, does the appraisal, the appraiser, 280, value meets. Rental income, market rent, we needed 2,000. The range was 1950 to 2150. I said, perfect, this is great. So that $50 a month, that's $600 a year, according to the lender. They came back and said, hey, appraisal came in for the market rent, $50 light. We now need the client to do XYZ. And the XYZ were absurd. Like, the numbers didn't make sense. They wanted them to increase their down payment by $30,000. And I said, this is what is happening here? So I went back to the lender, same thing, kind of like we did with the appraiser. I said, this doesn't make any sense. It's $600 a year. We're using basically half of that to offset. Like, there's no way this throws out the ratios by, enough that they need to increase their down payment by $30,000. The next response was, hey, yeah, sorry, did my calculations incorrectly. You're right. Everything's fine. Broker complete. It's like, okay, great. So it went from like super panic. We're like, how am I going to tell this client they need to come up with another 30,000 to, whoops, we're good. And I mean, everyone makes mistakes. I mean, I'm not necessarily even blaming the underwriter. It's just these things happen. And that's why also for us, it's important to understand like what impact these things have on the file and know when we can push back to be like, this isn't adding up. This doesn't make sense. This value isn't accurate or whatever, right? And these things happen all the time. Just kind of like, tales from the streets here from Dave and Paul of the day-to-day nuances that we deal with. But that was something that completely threw. I saw the appraisal. I'm like 19. I'm like, I just knew right away. I'm like, this is going to cause an issue because they specifically said like we can't be 0.01 higher than this TDS. We're already making an exception on that number, right? Which is typically 44% of their overall income.
Good times. Just some added stress ulcers unnecessarily.
Your home is one of your biggest investments, and the team at Big Westboro can help you protect it. Our expert brokers will find the perfect coverage to keep your home and belongings safe. Call 613-239-5792 or visit thebig.ca/Westboro for a free quote. Think big, protect what matters most. Are you trying to grow your mortgage business? Centum has the tools and support to help you take your business to the next level. Get access to everything from free unlimited custom marketing to daily direct pay. Find out what your business can do with Centum. Learn more at joincentum.ca. Are you thinking of buying or selling a residential property? Relationships are at the heart of every real estate transaction at Guertin, Poirier, Avocates lawyers. We love to bring residential buyers, sellers, agents, lenders, mortgage brokers, and the law together to close the deal for you for an effortless client experience that opens doors. Call us at 613-744-4488 or visit our website at guertinpoirierlaw.ca. Let's get to the heart of your deal. This episode is brought to you by Easy Neon Signs. Visit easyneonsigns.ca and use the promo code TOREP, TOREP, to get 20% off each and every order. easyneonsigns.ca, Canada's finest custom neon sign maker.
Something else I'm seeing and that I wanted to ask you about was gifted down payments. So I know we discussed, I think there was an article that we went over months ago about gifted down payments increasing and people getting like, and I think we even talked briefly, not tax advice, about the tax benefits of getting that inheritance or whatever early in the form of a gifted down payment so that you kind of, you get that equity and so on. It seems lenders are, at least from what I've seen, are digging a bit deeper into the source of those funds. In the past, it used to be, a gift letter show the subsequent deposit into the account, and that was it. I've had lenders now more frequently wanting to see the actual 90-day history of the money before it was sent to the receiving client. Sometimes they want confirmation of the transfer, of the draft, or what have you. So they're digging a bit deeper into the source of those funds. But I had a situation yesterday where a client had received a gift. They were planning to put kind of a portion of savings and a portion from a gift from their parents, which they'd received about a month ago. They'd taken the money from the gift and actually invested it into their FHSA because they didn't know when, like they knew they're going to use it for their home, but they didn't know when they were buying and hadn't found a place and hadn't been pre-approved. It was just kind of like, this is our hypothetical plan. So the money was in the FHSA. On the weekend, they secured a property. They gave their they wrote the APS. The deposit was $10,000. They basically went into their bank to withdraw the $10,000. Similar to an RSP, takes 2-3 days to settle back into their account. So the client is now thinking, oh shit, I have 24 hours to basically produce this deposit. The money's in my FHSA. I can't get it out. What the heck am I going to do? So now the client is getting an additional $10,000 gift, which is going to be put into their account from his father. We're going to use that as the basic proof of deposit. And then the withdrawal from the FHSA is going to be essentially like a repayment. So we're going to have to figure this out. Like, I don't know if the lender's going to want an additional gift or if we can just show the repayment back. Typically, I can just show, hey, he got $10,000. This is why we got the money from the FHSA, paid him back. Like, there's going to be all these moving parts, but this is, again, just the things we deal with. So like, if you're at a point where you're putting in offers, you're out shopping, like make sure you have your ducks in a row. Make sure you've had those conversations. Like, where is your deposit coming from? Where's your down payment coming from? Get pre-approved. Ask your broker these questions so that you're not put in a position where you're calling the bank of mom and dad at 8 p.m. stressing because you have 2 hours to produce a $10,000 check,
And don't move your funds between 8 different accounts in lead up to it.
Yeah. Now, there are times where, like in this case, these people are, they might have been shopping for another 6 to 12 months before they found something they really like. So like, I get it. You want to have it invested. You're getting some interest or some growth in that money. But if you're actively shopping and you're going to be buying a place in the next 3 months, like try to get everything consolidated and make it easier on yourself as well,
Now speaking of shopping, we have some stats. We have some
Amazon Prime
Ottawa market stats. So Ottawa's market moving into the winter with steady footing. Sales rose 8.1% from September to 1,177 transactions, even though they sit 1.2% below last October. Prices continued to show quiet strength. The average sale price reached $709,000, up 2.7% month over month and 5.7% year over year. So again, 5.7% up in average sale price year over year in Ottawa. Inventory is still elevated compared to past years, but it is lowering. So active listings dipped from 4.4 months to 3.6 months. And new listings followed a typical seasonal pattern, dropping 15%, so 15.1%, but remaining 13.4% higher than last year. Year-to-date performance reinforces the same steady rhythm. Ottawa has logged 12,197 sales so far in 2025, up 3.3% from the same period in 2024. Total dollar volume for transactions in Ottawa, $8.55 billion, a 6.5% annual increase. So I thought that's pretty interesting that we're up 3.3% in sales, and that from a dollar volume perspective of purchases at $8.55 billion in mortgages. While the average year-to-date price of $700,869 is up 3%. October alone generated $834.5 million in sales volume, 4.5% higher than last year. Anything in there that stood out to you as well?
So anyone who's listening, I have up on the screen right now the actual, just kind of like a summary of the numbers, and I have October and September here, so I can just kind of flip between the two. So just looking on the left side at like the overall market update stats, the one thing that I found interesting is that the days on market have extended by 3 days. So in September it was 23 days on market. It's 26 in October, so an addition of 3 days. The benchmark price, so single family home, $692,400, down from $697,200. So the prices continue to kind of decrease month over month on average, but days on market extending, which typically would indicate like a slightly cooling market. Now 3 days to me is like, very nominal, like really basically on par, like not much of a change. Condos in September, 408, 200, 402, 900. So both single family and kind of the apartment slash condo market decreased month over month. And the number of listings, kind of what we were speaking to, September 2832 and October 2405. So everything kind of seeing a decrease except the days on market, which saw an increase. And the properties sold went up slightly as well, but 100 extra properties sold in October. But yeah, I found the fact that there's less new listings not overly surprising. Like I think November will be even lower. Like it's kind of, as we said, as you roll into the winter, it seems to be people kind of remove their listings, kind of put them back up in the spring. But nothing overly, like sales activity is kind of on par with where it was last year. Months of inventory slightly higher, but that's kind of to be expected. And, you know, I think anything under 30 days on the market, if you're a seller, is not a bad thing. Like that's a pretty good average to have. But I still think we're in a strong buyer's market. Like every seller I talk to is nervous about selling their place, and every buyer I'm talking to is excited about the prospect of so many listings and so many opportunities. So like the sentiment from buyers is positive. The opinion of sellers is that they're nervous that either they're not going to sell or they're going to have to sell for less than what they want. Or so, like to me, it's a clear buyer's market. Now, I don't know. I don't think the stats show that yet, but I think it states that we're in a neutral market. But just from what I'm seeing in the streets, like it's a buyer's market. If you're a buyer, like you're kind of holding the cards, you're able to negotiate. As we always say, there's always those outliers where, you know, there's 10 buyers that want it. That's going to obviously prompt, you know, a great opportunity for the seller to get multiple offers. But in most cases, if you're a buyer, you're going to see a property. It's going to probably have been sitting for 15, 20 days, and there probably will not be any other offers on the table when you go see it. So that's a great position to be in if you're a buyer.
No, I agree. It's it'll be interesting to see as we roll through November whether the trend kind of continues of that days on market decrease and where we end up the year, you know, on that sales transaction figure, if it kind of continues that upward trend through of sales activity rather, and through the end of the year, kind of that, you know, when we said it months ago, you know, it being like likely a delayed fall market. So again, to be seen. One topic that kind of came up, or some stats that came up as well in this past week, was the unemployment
Yes.
rate in Canada. So the job numbers came out from StatsCan, and really kind of likely affecting, you know, the Bank of Canada rate decision. Economists are kind of predicting. I mean, the figures of like percentage odds of a rate drop by the Bank of Canada is, you know, pretty low for this next upcoming announcement. But this StatsCan jobs number really kind of, you know, possibly reinforce that. But there is an interesting figure in there. So the unemployment rate dropped 0.2 percentage points to 6.9%. The economy added 67,000 jobs. However, they were concentrated in part-time work. So StatsCan said on Friday that the gains were driven by job creation in wholesale, retail, transportation, housing, and youth unemployment saw the first decline since February, falling 0.6 percentage points. However, that youth unemployment, that's ages 15 to 24, it's still at 14.1%, which is pretty wild. The Scotiabank economist Derek Holt said that it's not a great quality signal that an 85,000 increase in part-time jobs drove overall gains, while the number of full-time positions dropped by 19,000. So when kind of looking at the underlying figures, you know, it's driven these gains driven by part-time work. So 67 jobs isn't, you know, 67,000 full-time jobs. Now, there were a lot of economists actually indicating that this was driven by my beloved Blue Jays and their run to the World Series. So
No way.
what they were stating was, you know, especially in and around Toronto being a driving market, that they were seeing massive gains in number of hotel nights. So temporary staffing at the hotels to cover those extra 1,000, you know, I think it was 12,000 extra nights of hotel stays per night. And then as well, the increases of restaurant and retail activity up 20 on game days and in around game days of up 27%, and that based on Moneris's numbers. So it'll be interesting to see now that run is over, and kind of, you know, that kind of spread amongst not just within Toronto, but other markets across Canada, of people going out to watch the games at restaurants and things like that. So I think it'll be interesting to see, you know, now that they're not playing, whether that, kind of comes back down at the next StatsCan number, and whether that was just a temporary bump, because it is all part-time work that was really brought in and boosting that number. So we'll see if that is the cause and effect. But I thought that was what a lot of economists were saying, and same with Moneris' numbers in and around the stadium of Rogers Center and things like that. I thought that was kind of an interesting figure.
That's very interesting. And I wonder how, like, even leading into the holidays, like I have clients now being like, oh, I got a seasonal job at LCBO or whatever, like, thinking that they can, like, obviously we need more consistency.
Yeah, seasonal adjusted.
But yeah, that's seasonally adjusted. So that's why, like, when they're coming out with these job numbers, they do seasonally adjust those numbers and for obviously policy changes and so on.
Yeah, exactly. Time will tell, obviously, of where things settle, but overall,
well, hopefully the Blue Jays do this every year, so we have to seasonally adjust for Blue Jays playoffs. For job numbers, that would be ideal.
Be a lot of refinances of ticket debt.
yeah. Those equity takeouts for playoff tickets. Should we slide into some mood boost, David? Leave on a high note here.
I think so.
And you tell me what you think here. Number one, what do you call a pony with a cough? A little horse. I like that one. That one's good. Number two, parallel lines have so much in common. It's a shame they'll never meet.
Yeah. Like the little pony.
Yeah.
Little pony.
Yeah.
Little horse. That was a good one.
Yeah. Thank you again to our amazing sponsors. Guertin, Poirier, Avocates Lawyers, Big Insurance in Westboro, Centum, and EasyNeonSigns.ca. I actually had 2 people in the last week that wanted to order signs, and they texted me, and anytime anyone asks me about the signs, I literally just text them back like, EasyNeonSigns.ca, like, use the promo code TORREP to get just like literally copy and paste what I say on the show. So it just ingrains in their head, like, here's the promo code, here's what you get for it, But yeah, thank you to all of our sponsors. Thank you for listening. Thank you to our listeners. And thank you once more to all of our servicemen and women. We appreciate you. We remember. And have a great week, everyone. We'll be back next week, Wednesday, 10 a.m. We're back on our original scheduled programming here. David, have a great week. Great to see you. Welcome home.
Deuces.